Welcome to the Commercial Real Estate Show, your source for insightful analysis and enlightening discussions. Hello, I'm Michael Bull. Thanks for being with us today on one of the 40 radio stations, YouTube, iTunes, or the show website, CREshow.com. Well, today we're going to talk about crowdfunding for investors and sponsors. You know, crowdfunding has become a very popular way for sponsors of real estate investments and developments to raise capital. It's also been popular for investors to be able to go online and invest in commercial real estate deals. Please welcome my first guest, Doug Elinoff. He's partner with Elinoff, Grossman, and Scholl. Doug, thanks for joining us today. We appreciate you being on the show.
Hello, Michael. Greatly appreciated. I appreciate the invitation to come and speak to your audience.
Well, thank you. And I've heard you at events. I've interviewed you before. Our listeners are in for a treat related to crowdfunding. And you do a lot of crowdfunding work in your law practice, right?
We do. The law firm is over 20 years old, and we have a variety of different areas of practice, including real estate and a lot of securities work and litigation, and it is through our exposure to securities that we first learned about the Jobs Act and crowdfunding 3 years ago. And with the securities lawyers and the real estate lawyers in the firm, we've devoted a lot of time and attention to real estate crowdfunding during that same 3-year period, even though the firm dates back much longer than that.
Okay. And to get us started, tell us briefly about the Jobs Act and how sponsors were able to begin advertising to attract accredited investors.
Well, the Jobs Act has a variety of different components, Michael, but the areas of the Jobs Act that your audience would be most interested in are really what provisions are referred to as Title II and Title III crowdfunding. And Title III, I'll just mention quickly, because it may become important to your audience later on this year, and that involves the investing in all activities, including real estate, for both accredited investors, those people of greater means, and unaccredited investors, those people that don't have $200,000 of income a year or $1 million of net worth. And that Title III program, which is really what we refer to as crowdfunding because it's the broadest group of people who can participate, is the genesis of a lot of the thinking that went into the Jobs Act, even though that provision remains subject to the Securities and Exchange Commission enabling their proposed rules, which just hasn't happened yet. With that as the backdrop, what is happening and has been happening since September 23rd of 2013 are the Title II provisions, which also affects the real estate market and allows a sponsor of a real estate campaign or project to raise money through what we call general solicitation, as you pointed out, which permits a sponsor, a real estate developer, to generally solicit and market their proposed project online or offline, whereas in Title III, it has to be done through a funding platform, a technology website. Title II doesn't require that it be done through a funding platform, although what I spend most of my time, as you mentioned earlier, is working with the crowdfunding portal community, which is the technology solution that enables real estate developers and sponsors to raise money for their projects. And that's only from accredited investors, again, people of greater means.
Okay, so before the Jobs Act, sponsors of real estate transactions looking for investors couldn't just advertise in newspapers and they couldn't do websites, but at this point now they can, and if they're to accredited investors, is that right? But there may be a change soon that will allow them to advertise and bring in investors who are non-accredited?
Correct. The presumption under the U.S. securities laws as of 1933 is that if you want to raise money from the public at large and do a general marketing campaign, you have to register those securities with the Securities and Exchange Commission. There are exemptions, and it's those exemptions that the crowdfunding provisions fall into. And Title II, which is an enabling statute that permits real estate folks to raise money privately, although a little bit strangely, with public general solicitation. So it's a private placement, the way real estate professionals have been doing for years, Reg D offerings, friends and family finance. Now they'll be able to do the same sort of capital raise, but the only requirement is that the money that they raise only be from accredited investors. And not only that they be accredited investors, they have to be, the developer or the real estate professional has to take reasonable steps to verify that those investors are actually accredited investors, unlike what's been going on for the last 80 years where you just ask the individual investor for reps and warranties that they're accredited. That will not be sufficient in Title II if you want to take advantage of the general solicitation provisions now. You actually have to take reasonable steps to verify their accreditation.
Now, are you suggesting that possibly in the future that that's going to change, that you'll be able to raise capital from non-accredited investors?
Well, the Title III provisions are is limited if... Well, let me back up. I apologize. Yes is the answer to your question. When Title III becomes available, any real estate developer can raise up to $1 million, or a real estate sponsor, through a crowdfunding platform. And they can do a general solicitation of sorts. It has other rules that aren't implicated by Title II. But it's only $1 million financings, and it's from both accredited and unaccredited investors, but it has to be done through a funding platform. And that funding platform, which acts like a mini broker-dealer, has a lot of responsibilities on information requirements, educating the investors, and limits how much money an individual investor can put into any one deal, as well as, and this is the unfortunate part for the real estate industry, is the real estate individual who's looking to raise money can only raise money one time in that 1 year period, and the way the rules work is that it limits you so you can't do multiple different raises to multiple different entities. So $1 million may not be ideal for real estate folks in Title III.
Right. So for commercial real estate, it's probably limited more to accredited investors because most deals are going to be over $1 million, right?
Correct.
Okay.
Correct. And the information requirements and the fees are a lot less in Title II.
Right.
So Title II is what's going to be more relevant for your audience, and that's why it has taken off, as you're well aware, over the last 15 to 18 months.
Yeah, and how much has it taken off, Doug? I mean, how much equity do you think has been raised through crowdfunding since 2013?
Michael, it's a little hard to tell, is the truth, because some of the numbers that I'm seeing are a little polluted. But I'd say somewhere between $500 million to $1 billion has been raised in Title II campaigns by real estate folks online. Offline, it's multiples of that, but through online funding platforms, it's many hundreds of millions of dollars. The websites that are best known in this industry, which I'm sure you're well aware of, are Realty Mogul, Fundrise, Prodigy Network, the Real Crowd, Realty Shares. There are, at last count, I saw nearly 70 real estate crowdfunding-related sites, including CrowdStreet, Block Shares, a whole slew of new entrants to the market as well.
And it's really ramping up, isn't it, the volume that's being raised?
Not only are the number of deals that are looking to raise money online going up, the amount of money being raised per deal seems to be increasing. The investor appetite for these deals is increasing as people get more comfortable with the quality of the sites, the diligence, and the deals that are being put up. So all in all, the real estate crowdfunding portal community is very excited with what they've seen over the last 18 months.
Right. And quickly, we're right before the break here. We're going to have you back after the break. What are a couple of the benefits to sponsors of utilizing crowdfunding?
The real estate industry understands syndication in a way that's very different than venture capital and angel investing has been done for many years. Most real estate is done with some form of syndication, except at the highest levels of the largest deals. So what this allows a real estate professional to do is, A, through the technology portal, it's a much better communication device, even to those investors that they have had a historic relationship with. But it also helps facilitate relationships through social media, Facebook, Twitter, to get the word out in a more efficient way about the deals that the individual real estate sponsor has. So from a real estate sponsor's point of view, it's broadening their reach to a wider audience, doing it in a more efficient manner with standardized communication tools to hopefully close deals more quickly with more investors with larger sums of money.
All right, stay tuned. We'll have more on crowdfunding. This is the Commercial Real Estate Show. All right. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Thanks for being with us. Today we're talking about crowdfunding for sponsors and investors. My guest is Doug Elinoff. He's with Elinoff, Grossman & Scholl, and he does a lot of work in the crowdfunding world. And Doug, there's various types of websites that are in the crowdfunding space. Can you tell us about kind of the differences of the major types of sites?
Michael, although there are the 70 different crowdfunding platforms that are in the real estate industry already, there are three primary business models that these crowdfunding platforms operate under. One is a broker-dealer model, and that's pretty straightforward. The funding platform raises money for campaigns from their investor community and takes a commission, which is called transaction-based compensation, and consequently that platform has all of the duties and responsibilities that a broker-dealer has in a regulated industry, and they get the commission in exchange for being a licensed professional. And that's the only model that it allows a funding platform to get a commission. If somebody's getting a commission that is not a licensed broker-dealer with FINRA, there's a problem. But the benefit of being a broker-dealer, besides getting the commission, from an investor's point of view, is also that there are responsibilities like due diligence that we'll come back to shortly. The next model is where the funding platform is not a broker-dealer necessarily, and they put together the investors with the real estate campaign, and they put the money into a fund. And as part of being a GP or general partner of that fund, they get performance-based compensation, which is distinctly different than transaction-based compensation, and they will participate in the performance of the underlying real estate cash flow, and they will get some performance compensation, whether or not it's a certain amount of money after after a threshold amount, or they will just get some money later on when the real estate asset is sold, and that is permissible under the performance rules, which would be an exemption to broker-dealer. There are other guidelines that you have to be careful not to do if you're a funding platform, if you don't want to be deemed to be a broker-dealer, but that is what a lot of the existing sites are doing. They're matching money with deals, and they're participating as a general partner. And in certain cases, they can also get, and it may appear, but it is not, transaction-based compensation like a fund manager. They get 2 and 20, and the 2% is not paid to them day one like a commission. It's paid for the ongoing advisory and monitoring of that individual deal.
Okay.
And that's called an SPV model for a special purpose vehicle. And the third is a posting site where the site gets paid by the real estate sponsor for listing the deal on the site, and that's all they get. They don't get any. It's not a percentage of the amount of money raised. It's $500, $1,500 per listing. And those are the three different models.
Okay. And, of course, it's caveat emptor, right? Buyer beware if you're investing in anything. But of these different types of sites, what type of due diligence do they do on the actual projects and on the sponsors?
Interestingly now, notwithstanding that there are very different due diligence responsibilities of each of those three models, for the most part, this new industry is trying to operate very responsibly, and so all of them tend to be doing some level of due diligence because regardless of the regulatory requirements, no funding platform is going to be in business very long if they allow bad deals to be posted to their sites. So they are trying to be as careful as they can be. But I think it is fair to say, notwithstanding their good intentions, a regulated, licensed broker-dealer has the highest regulatory responsibility to do actual due diligence. That's background checks on the real estate professionals. It's doing some kind of verification of the underlying real estate asset, looking at the numbers, and a whole host, maybe looking at the leases if it's commercial property, but it's a fairly healthy amount of due diligence they have to do as it relates to being a broker-dealer. In the SPV model, the real estate portal is a general partner, and with that comes common law fiduciary responsibility standards for managing other people's money. Now, in some cases, the funding platform will put money into the individual deals as well, which is a good thing to see, and I would encourage investors to look to see if the funding platform is actually putting their own money into deals, because that's always a good sign for investors in any type of asset. And that then followed up by how much diligence are they doing, even if their own money is going in. And even though they're not a regulated broker-dealer, you want to see that they're doing substantially the same sort of due diligence for completely different reasons as the broker-dealer. The posting site doesn't have any such due diligence responsibility by statute at all, even though, as I mentioned earlier, some of them are doing it because it just makes good commercial sense.
Right, yeah, that makes sense. They're going to go out of business if they're doing bad deals. They're not going to be around long. Well, what are some gotchas? What are some precautionary tips that you would give to sponsors who want to utilize crowdfunding?
Well, one of the things that we've observed in our real estate practice over the years, Michael, is that real estate professionals, sponsors, developers don't just typically take one type of fee in a deal. They have a series of different revenue streams associated with their business model, whether or not it's real estate brokerage fees, acquisition fees, leasing fees, maintenance fees. And the securities laws are very clear that all money that can otherwise be paid to the real estate sponsor or its affiliates must be disclosed in great detail so that an investor, when they're making the investment through the funding platform, knows what's coming out of their investment and benefiting the real estate sponsor.
Yeah, so that's a great tip. Just be very straightforward where all the money's going, right?
That's certainly that's the easiest way for an investor to get unhappy and take action.
What are some examples of the three types of sites that you talked about, crowdfunding sites? What are some of the names of some to give an example of each one?
The best-known sites so far are Fundrise, which is in Washington, D.C., and that I believe they are an SPV model. Realty Mogul out in Los Angeles is an SPV model. Then there is a posting site called CrowdStreet out west in Oregon. And then as it relates to the broker-dealer model for real estate, I don't have one off the top of my head. I'm sure there are some that are out there. But I think your audience should also look at Prodigy Network. They're doing very interesting things. And if you go online and do Google search for these platforms, many will come up. There is a data aggregation firm called Crowdnetic, and Crowdnetic puts out a lot of very good information about the percentage of deals that are being crowdfunded under Title II that are real estate related.
Okay. Well, Doug Ellenoff, thanks for joining us today. We appreciate you being on the show.
Michael, my pleasure. You have a good day.
Thank you. Well, stay tuned. We're going to have more on crowdfunding, and crowdfunding is interesting. I talk to sponsors out in our industry that aren't aware of crowdfunding. There could be some great benefits, and of course, you need to be careful, as Doug said, how you do it. And for investors, it's going to be interesting when you can invest online like you can in the stock market in commercial real estate deals. Things could change. I'm Michael Bull. This is the Commercial Real Estate Show. Stay with us. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Advisors, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive and powerful suite of commercial real estate tools at an incredibly low price. Visit realnex.com. That's RealNex. FIU, Florida International University. Earn your master's in real estate in as little as 10 months without interrupting your career. Visit FIUonline.com. Xceligent, the resource professionals use for commercial real estate information. Visit Xceligent.com. That's XCELIGENT. Commercial Search, the source to market and source available properties for sale or lease. Visit commercialsearch.com. For more information on these great companies or for additional videos, podcasts, or articles, visit CREshow.com.